Hi everyone, welcome back to the channel. Here we don't just talk about price, we talk about understanding. And today I want to clear up one of the biggest misunderstandings I keep seeing around XRP. A lot of people aren't actually wrong about XRP, they're just looking at it through the wrong mental framework. They're asking trading style questions about something that was never built to behave like a typical trade. And when you put an asset in the wrong category, everything that follows feels confusing, frustrating, and disconnected. So instead of debating price targets, timing, or asking when it's finally going to move, I want to explain why XRP keeps getting misunderstood and why that misunderstanding is the real reason so many people feel impatient or stuck right now. Before we go any further, quick disclaimer. This is not financial advice. This video is for education and perspective. So you can think more clearly about what you're watching on the chart. And if you appreciate breakdowns like this that can help you see the bigger picture, make sure you like the video, subscribe to the channel, and drop a comment below. I'm curious, do you personally think about XRP more like a short-term trade or more like a long-term system-level asset? Okay, one of the biggest mistakes people make in markets is evaluating things using the wrong framework. We do this in everyday life too. You wouldn't judge a highway the same way you judge a coffee shop. You wouldn't evaluate a power grid the same way you evaluate a startup. And you wouldn't assess financial infrastructure the same way you assess a speculative asset. But that's exactly what's happening with XRP. Most people are trying to understand it using tools that were never meant for what it actually does. So before we even talk about the price adoption or future potential, we have to fix the category error, because once the category changes, the way everything else makes sense changes with it. Here's the core mistake. XRP keeps getting evaluated like a stock, a growth asset, or something you buy hoping company decisions push the price higher. But XRP isn't a claim on a company. Owning XRP doesn't mean you own Ripple. It doesn't mean you are entitled to profits, quarterly earnings, or that its value depends on corporate performance. So Ripple couldn't have an amazing year or a terrible one and XRP would still exist. That alone tells you it belongs in a different category. XRP is not equity, it's not ownership, it's not a business. It's a functional asset. Its value doesn't come from revenue. It comes from what it enables inside the system. And this is where most people lose the thread. Systems don't care about stories or narratives. They care about speed, reliability, capacity, and performance under pressure. That's how infrastructure is evaluated. So when people ask, why hasn't the price moved yet? What they're really asking is consumer style question about something that was designed to solve system level problems. Until that distinction clicks, XRP will keep feeling confusing, not because it doesn't make sense, but because it's being viewed through the wrong lens. Once you fix the category, the next step is understanding how systems define value. So retail tends to define value by price movement, which is why so much frustration shows up, especially when price goes down. But institutions don't think that way. They think in terms of capability. They're not asking, can this go up 20% this quarter? They're asking, can this move value when volume spikes? Can it settle without friction? Can it operate when other rails are stressed? And does it reduce uncertainty or add to it? That's the lens. Large financial systems don't fail because something becomes auto, they fail because money stops moving efficiently. Settlements slow down, liquidity fragments, contractory risk increases, and suddenly what worked yesterday doesn't work at scale today. That's when value gets redefined. Assets that reduce friction becomes more valuable. Assets that introduce delay becomes liabilities. This is why infrastructure doesn't reprice the same way consumer assets do. It doesn't move because of excitement. It moves because of necessity. And necessity doesn't announce itself loudly. It shows up quietly in testing, integration, assets, legal clarity, and system design. And this is also why price is often the last thing to change. Before price moves, you see rails being built, assets expanding, regulations being resolved, and integrations happening behind the scenes. These things don't trend on social media. They don't show up as a massive green candles, but they matter far more than headlines, because once a system starts depending on assets, the question is no longer whether it's interesting. It becomes what happens if this isn't available. That's when behavior changes. That's when positioning replaces speculation. And that's when repricing becomes structural, not emotional. A lot of people feel frustrated here because they are trying to measure system level changes with short-term tools. And if you've ever studied how liquidity, infrastructure, and market plumbing actually work, this can feel slow, disconnected, and confusing, when in reality, it's just happening at a different altitude. This kind of understanding doesn't come from headlines or social media posts. It comes from learning how markets actually function. That's why I'm always emphasizing education, real market literacy, understanding cycles, reading structure, managing risk, thinking beyond hype and signals. If you want to build that kind of foundation, check the link in the description. Everything I share is focused on helping you understand the way behind market movement, not just reacting to them. Now, let's pull this together. When people talk about regulation or adoption, they often imagine some perfect future moment, everything finalized and rules clear, and then suddenly price moves. But real systems don't wait for perfection. They move forward with certainty. When conditions are calm, inefficiency is tolerable. So you can optimize for cost, you can afford delays, but when stress enters the system, priorities change. Price stops being the sending factor. The question becomes what works ability, what removes uncertainty, what gets the job done without failure. That's correct. And when those questions take over, value gets extended, not emotionally, but structurally. That's why some assets can reprice very quickly when environments change, not because people suddenly believe in them, but because the system needs them. So when people ask, can XRP really be repriced? The real answer isn't that it will. It can under the right condition, and here's the key distinction. XRP doesn't need an emergency to succeed long-term, but high-stress environments accelerate repricing. They expose which assets are optional and which are necessary. If a system suddenly requires speed, finality, deep liquidity, and legal usability, and only a few tools can provide that, those tools don't stay priced like conveniences. So they get repriced based on necessity, not hype. That's why I'm carefully with the language here. I'm not making predictions, and I'm not giving timelines, and I'm not offering guarantees. I'm talking about liability. So XRP is liable to matter when certainty becomes the priority. Once you understand that, the conversation changes completely. The question stops being why isn't this going to the moon, and becomes what happens if the system suddenly needs what this asset was built to do. Now let's talk about the final mistake people make with XRP. And it's not about how they see, it's about how they plan around it. So most people build a strategy based on what they think the asset is. So if you think XRP is just a trade, your plan becomes buy here, sell there, try to time, hope you don't miss it. There's nothing wrong with trading, but if that's the wrong category, even a perfectly suited plan leads to the wrong outcome. Your strategy always reflects your understanding of the end result. So if you don't understand what something is designed to become, you can't reverse engineer the right plan. Once you see XRP as a system asset, not flip, the strategy changes. It becomes about optionality, collateral use, yield, borrowing, rotation into cash flow assets, diversification without existing, creating multiple income streams for a single base. That's completely different wealth framework. So instead of asking, when do I sell? The question becomes, how do I use this intelligently over time? That's how institutions think. That's how long-term wealth is built. This isn't about telling anyone what to do. It's about helping you understand what you are holding. When understanding changes, behavior changes, and when behavior changes, treasure changes. So that's how people stop reacting and start positioning. That's how wealth gets built intentionally, not accidentally. If this video helped you see things more clearly, that tells me you're not here for hype. You are here for understanding it. And if you want to go deeper and build a real long-term strategy with clarity instead of stress, check the link below. Make sure to like the video, subscribe to the channel, and stay connected. As always, stay sharp, stay patient, and I'll see you in the next one.